Markets tumbled overnight, billions vanished in hours, and the screens at the Bank of Canada lit up red. Traders froze, analysts whispered, and then, sources say, the governor lost his cool. The calm technocrat suddenly faced a crisis that no textbook could solve. Behind closed doors, phones rang non-stop as emergency meetings stretched into dawn. Was this just a market correction, or the moment Canada's entire financial system was pushed to its breaking point? Canada's fragile position in the global market meltdown,
and our outlook for the Canadian economy. Today, the bank lowered the policy interest rate a further 25 basis points, bringing it to 2.25%. This was our second straight cut and reflects ongoing weakness in the economy.
It was a global event. Canada found itself especially vulnerable. For one, the Canadian economy is highly trade exposed, especially to its southerly neighbor. Key export sectors such as autos, steel and aluminium, lumber, and energy all intersect with U.S. market access and tariff risk. The 2025 U.S.-Canada trade war deepened this vulnerability. Canada's participation in integrated supply chains with the United States means that a disruption in cross-border trade or an unexpected tariff shock quickly ripples through. Investors describe that early April week as one of the most chaotic since the pandemic era. Trading desks saw wild swings across nearly every major asset class, with liquidity evaporating as volatility spiked. Canadian pension funds and institutional investors, often heavily exposed to energy and materials, faced sharp portfolio markdowns as oil prices tumbled on expectations of reduced global demand. The Canadian dollar, long seen as a petro-currency, slipped further against the US dollar, reflecting both lower commodity prices and investors' flight to safety. Meanwhile, bond markets, usually a refuge during equity sell-offs, offered little comfort. Yields fell briefly as investors sought security, but soon rebounded amid fears of inflationary supply shocks, a rare and unsettling double move that left traders uneasy. For ordinary Canadians, this financial turbulence translated into real-world anxiety. Market losses dented retirement accounts and investment portfolios. The slide in commodity prices raised fears of layoffs in mining and energy hubs, particularly in Alberta and Saskatchewan. Businesses that relied on exports suddenly faced tighter credit conditions as lenders grew cautious. What made the situation even more unnerving was how quickly confidence eroded. Analysts at major banks began warning of a potential confidence recession, not one driven by weak fundamentals alone, but by sheer uncertainty. The Bank of Canada, watching these developments closely, recognized that the panic was as much psychological as it was financial, a reminder that in globalized markets, sentiment can crash faster than numbers. How the Bank of Canada responded to a perfect storm of panic and policy uncertainty.
Today, we also published our outlook for the Canadian economy. Putting those two things together, we have four main messages. First, U.S. tariffs and trade uncertainty have weakened the Canadian economy.
Firms slowed hiring and investment. Consumer and business confidence slipped. In its May 2025 Bank of Canada Financial Stability Report, the bank explicitly noted that following U.S. tariff announcements in early April, the world saw a significant rise in volatility and that the bond market sell-off had been a particular concern. Put simply, the crash hit Canada harder because Canada was both connected to the global financial shock and structurally exposed to trade shock risk. Thus, the crash in April 2025 was both a global equity and bond market meltdown triggered by tariff shock and trade uncertainty, and a Canadian economy that found itself in the crosshairs thanks to its export concentrations and supply chain ties. When readers see a headline like "Governor of the Bank of Canada freaks out after market crash," it naturally conjures images of central bank panic, emergency policy moves, and frantic interventions. What happened in reality is more measured. The Bank of Canada did indeed respond to elevated risks and volatility, but by all appearances, it held its course with caution rather than panic. To begin with, on April 16, 2025, the bank held its overnight rate at 2.75%. This followed 7 consecutive rate cuts and marked a pause rather than an aggressive leap to action. The bank publicly cited the major shift in direction of U.S. trade policy and the unpredictability of tariffs as reasons for the pause and pointed to 2 scenarios. One with limited tariffs, growth weakens modestly, inflation around 2%. The other, a protracted trade war, deep recession, inflation above 3%, and emphasized substantial uncertainty. The Financial Times captured the moment succinctly. The Bank of Canada announced it would keep its benchmark interest rate as a precautionary measure. Caution over chaos. How the Bank of Canada chose stability instead of panic,
with some pickup in 2026. Second, while this weakness is restraining price increases, the trade conflict is also adding costs for many businesses, putting upward pressure on inflation.
Then came the May 2025 Financial Stability Report, in which the bank acknowledged elevated risks, particularly from trade and market volatility, but refrained from declaring an emergency. The tone was sober and cautious. The bank spoke of global markets being roiled, but emphasized that the Canadian financial system remained resilient. On June 4, 2025, the bank again held its rate at 2.75% and noted in Governor Tiff Macklem's opening remarks that the extreme financial turmoil we saw in April has moderated and stock markets have recovered their losses. In that statement, he said the Canadian economy was softer but not sharply weaker, and that the trade conflict initiated by the U.S. remained the biggest headwind facing the Canadian economy. This strategy also showed how the bank had learned from past crises. During the 2008 financial collapse and the 2020 pandemic, rapid interventions had been necessary, but they came with long-term costs, including asset bubbles and distorted credit markets. By 2025, the bank appeared determined not to repeat those mistakes. Instead of rushing to save the markets, it chose to protect the system's credibility. The message was subtle but powerful. Canada's central bank wouldn't move simply because investors demanded it. It would move only when the real economy required it. Behind the scenes, officials were engaged in detailed scenario modeling, testing how long the trade shock might last, how deeply it could cut into GDP, and whether inflation risks might return once supply chains adjusted. Each possible path required a different response, and Macklem wanted to avoid any action that could later be seen as premature. Communication, therefore, became its most effective policy tool. Every speech, report, and testimony was crafted to calm expectations and signal readiness without sounding alarmist. The approach worked. Within weeks, markets stabilized, the Canadian dollar regained footing, and investors started to differentiate Canada's measured stability from the turbulence elsewhere. The bank's quiet confidence became its strongest form of intervention. Traders saw chaos, the bank saw control. The April 2025 market meltdown unfolds.
To support the economy through this period of adjustment, we have lowered our policy rate by 50 basis points over the last two meetings and by 100 basis points since the start of the year.
When the global markets convulsed in early April 2025, traders witnessed a roller coaster of panic and reversals, equities dropping sharply, bond yields whipsawing, while the Bank of Canada, BOC, publicly maintained a steady clockwork message: monitor, observe, but do not panic. From the trader's vantage point, the trigger was the sweeping tariff announcements by the U.S. government on April 2nd that set off a global sell-off, with the major U.S. indices plunging in a matter of days. In Canada, the perception was amplified because the S&P/TSX Composite Index lurched downward and futures were hit hard. Those watching the tape saw bond yields behave erratically. After an initial safe haven move lower, they reversed sharply upward as liquidity and duration risks surfaced. Contrast this with what the BOC was saying. On April 16th, it held its policy rate at 2.75%, citing uncertainty from the trade shocks and saying that the traditional forecasting models were of little use given the tariff shock environment. That message was one of steady hands. The bank was not shouting alarm, but it was signaling caution. In May, in its Financial Stability Report, the bank admitted that equity and sovereign bond markets had seen large swings and elevated volatility, but affirmed that the Canadian financial system remained resilient. By June 4-5, the governor noted that the extreme financial turmoil we saw in April has moderated and stock markets have recovered their losses. That again suggested calm rather than panic. Thus, traders saw chaos. The bank saw risk, but responded with measured steps. The divergence is important. While markets flash crash signals, the central bank publicly communicates confidence in system resilience, even if behind closed doors it is scanning. Scenarios: the bank's action of holding rates in April and then calibrating later as growth softened illustrates this dual dynamic. Markets reacting swiftly, policy adjusting more deliberately. Winners, losers, and the real cost of the April shock for Canadians.
This was our second straight cut and reflects ongoing weakness in the economy and contained inflationary pressures. Today, we also published our outlook.
In short, the market theater was wild. The bank's message was steady. The impression of freak out in headlines may reflect how markets perceived the bank's silence amid the crash, but the actual policy posture was much more cautious and calculated. The April shock redistributed winners and losers in the Canadian economy based on trade sensitivity, leverage, and exposure to global risk. Among the obvious losers were trade-sensitive manufacturers and small exporters facing FX headwinds and tariff uncertainty. As global demand faltered, many of these firms found the export corridors suddenly much narrower. The BOC noted that job losses concentrated in August 2025 among sectors tied to exports, and Canada's unemployment rate climbed to 7.1% in August. Highly levered non-mortgage households also stood at risk. As markets and growth wobbled, credit stress for households with variable rates or secondary borrowing rose. On the institutional side, banks with large commodity or small and medium enterprise (SME) exposure were seen as at risk if the downturn deepened. That said, however, the Canadian banking system is subject to robust regulation. The Office of the Superintendent of Financial Institutions (OSFE) enforces liquidity benchmarks, LCR and NSFR, that strengthen resilience. Who quietly won? Some assets and firms positioned for risk-off days or structural shift gained. For example, gold miners benefited as investors retreated to safe havens. Commodity firms with hedged balance sheets found opportunities, and rate-sensitive borrowers gained once the bank began signaling easing. Firms with U.S. onshoring contracts, that is, Canadian suppliers benefiting from U.S. firms relocating production, found themselves better placed in the new trade shock environment. The mechanism is straightforward. In a trade shock world, those linked to resilient value chains or benefiting from the reshoring narrative get a boost, while highly exposed exporters suffer. From Bay Street to backyards, how the market shock hit Canadian homes and jobs. Thus, the money flowed away from high leverage, trade-vulnerable businesses and into resilience, hedged assets, and those aligned with structural shifts. The crash didn't hit everyone equally, and the winners were often those quietly lit candles, not the loud ceremony of the losers. When the market and trade shocks hit, they translate into concrete impacts for Canadians on their mortgages, jobs, and everyday finances. Take mortgages and HELOCs, home equity lines of credit. Suppose the bank moves rates by 25 to 50 basis points, BPS. A Canadian homeowner with a variable rate mortgage tied to HELOC. The overnight rate will see payments adjust accordingly. Even fixed-rate borrowers will feel it when they renew. For example, imagine a $500,000 CAD mortgage with a 25-year amortization. A 25 BPS, 0.25% rise might increase monthly payments by some hundreds of dollars. When markets crash and uncertainty spikes, lenders also reassess risk, making credit costs higher for HELOCs and variable lines. In the April crash, while the BOC held the rate then, the mere anticipation of policy moves made variable rate borrowers nervous, and fixed versus variable became a live debate in Canadian households. On jobs, the layoff wave hit sectors tied to trade and exports. As noted, Canada's unemployment jumped to 7.1% in August, with the labor force participation rate near its weakest since the pandemic. That means Canadians working in manufacturing, natural resource processing, small export firms, and supply chain jobs felt the pressure. Reduced hiring and more layoffs mean less room for error in household budgets. When you correlate that with high household debt in Canada, the risk of distress increases. Conversely, for Canadians in sectors insulated from trade shocks, for example, domestic services, some tech, resilient healthcare, the shock was less direct. But across the board, the message is, when global trade and markets wobble, what might feel remote in Ottawa or Bay Street comes home in payments, jobs, and credit. busting the myths. What the Bank of Canada really did during the 225 crash.
Second,
Même si la faiblesse de l'économie
while
limite
this
les
weakness
hausses de
is
prix,
restraining
le conflit
price
commercial
increases, the
entraîne aussi
trade
des coûts
conflict is
supplémentaires
also adding
pour beaucoup
costs for
d'entreprises.
many businesses,
Et ça crée des pressions
putting
à la
upward
hausse sur
pressure
l'inflation.
on inflation.
For the everyday Canadian, this new environment means living with a kind of financial whiplash, where interest rates, job prospects, and even grocery prices can shift faster than before. Borrowing costs may rise and fall in shorter cycles, forcing households to plan more defensively. The dream of predictable mortgage payments or steady career growth now feels more uncertain. For those working in trade-linked sectors like auto parts, metals, or energy, even a policy decision made in Washington can ripple directly into paychecks and job security in Toronto, Windsor, or Fort McMurray. Canadians are learning that global volatility isn't a headline from afar. It's a reality that shows up in their monthly budgets. Financial advisors now emphasize resilience planning, building emergency savings, diversifying income sources, and reducing reliance on variable rate debt. The shift isn't about fear, but awareness. When central banks tread cautiously and governments intervene selectively, individuals have to take more control of their financial safety nets. The same applies to small businesses navigating supply shocks or export uncertainty. For them, flexibility is the new survival skill. So while the noise of market crashes and political drama makes it seem like institutions are in panic mode, the truth is more grounded. The Bank of Canada's restraint isn't weakness, it's strategy. It's the difference between reacting emotionally and responding intelligently. Myth number 1, the bank panicked to save stocks. Reality, the BOC's mandate is inflation control and financial system stability, not the share price of the TSX. In April 2025, the bank held its rate at 2.75% despite the equity meltdown, signaling that it was not chasing the market but monitoring risk. Myth number 2, central banks print money the moment markets wobble. Reality, liquidity backstops exist, but they are conditional and not automatic. The BOC has tools such as term repos, the standing liquidity facility, and market functioning operations. But in this case, no emergency fire hose of liquidity was announced in April. The bank, in its May financial stability report, acknowledged large swings but said the system remained resilient and did not trigger crisis operations. In short, the BOC did not panic. Rather, it acted with forethought. It calibrated its policy stance as needed. Hold first, monitor, then ease when conditions pointed that way. This is policy discipline in action, not market panic in motion. In 2025, the Bank of Canada, BOC, found itself navigating a narrower lane than usual because the politics of tariff policy and Ottawa's growth agenda significantly constrained its options. The federal government's agenda, emphasizing multi-billion-dollar infrastructure and investment packages to offset the trade shock fallout, meant the central bank was operating in an environment where fiscal policy was front and center. For instance, in commentary on the 2025 federal budget, BOC Governor Tiff Macklem said Canada needs to create conditions that encourage private investment in order to recover from the tariff hit. He emphasized that that's not the responsibility of the Bank of Canada, but it is the responsibility of parliamentarians. The governor's warning, tariffs as a new economic reality,
is reducing our productive capacity as well as adding costs. This limits the ability of monetary policy to boost demand while maintaining low inflation.
In expanding on that February 2025 speech, Macklem's message was both economic and political in tone, a rare mix for a central banker. He was essentially warning that Canada was entering a new chapter in its economic story, one where old assumptions about frictionless trade with the U.S. could no longer be relied upon. The idea that Ottawa could simply spend its way out of the trade shock or that the Bank of Canada could cut rates until things fix themselves was, in his view, dangerously simplistic. He described tariffs as not just a temporary disruption, but a permanent recalibration of global value chains, forcing Canadian exporters to rethink markets, supply chains, and competitiveness. The subtext was clear. This wasn't a storm to wait out. It was climate change for the economy. Behind closed doors, policymakers in Ottawa reportedly faced their own tensions. The federal government, eager to protect jobs and growth, leaned heavily on fiscal spending, announcing industrial subsidies, trade credit programs, and regional support funds for affected exporters. Yet the BOC's caution stood as a counterbalance. Too much stimulus, Macklem hinted, could reignite inflationary pressures just as the bank was trying to anchor expectations after years of post-pandemic volatility. The result was a delicate dance. Ottawa pumping fiscal energy into the system, while the bank quietly held its line to maintain credibility and control inflation expectations. Macklem's remarks also reflected a broader shift in global central banking. Around the world, from Frankfurt to Washington, monetary policymakers were acknowledging that geopolitical shocks, tariffs, wars, sanctions were changing the nature of inflation itself. Prices were no longer being driven solely by consumer demand, but by fractured supply chains and the weaponization of trade. For Canada, a mid-sized, export-heavy economy, that meant traditional monetary levers could only do so much. Macklem reminded his audience that interest rates can influence spending and credit, but they cannot reopen ports, rebuild trade bridges, or rewrite tariff laws. In essence, his February address marked a turning point in Canada's policy narrative. It was an admission that structural problems required structural answers through diversification, innovation, and fiscal resilience. The bank would continue doing what it could, keeping inflation near target and ensuring financial stability, but it would not overstep into the realm of politics or fiscal intervention. In Macklem's words, the new economic order demanded coordination, not confusion, between Parliament and the central bank. The message was calm, clear, and sobering. Canada's economy had changed, and so too must its playbook. So, what are your thoughts on this? Let us know in the comments below.